Welcome to EWA's FIN-LYT podcast. EWA is a fee-only RIA based out of Pittsburgh, Pennsylvania. We hope all listeners of this podcast will benefit as we deep dive into complex financial topics that we will make simplified for you. And we hope that this really serves as a catalyst so that you can make the best financial planning decisions for your family and also save time. Welcome, everybody. Excited to be joined here by Chris Pavcic. We are talking today about 2025 financial planning limit. So there's been some changes, some significant, some stuff staying the same. So one of the things that we recommend to do, and we do for all of our clients, is go in and make all of these updates immediately in January to start the year. It's crazy to see the difference in a financial plan. If you're maxing out your 401k, and even if it's $500 every year, every 2 years, if you have the discipline to go in and make those adjustments up, it can make a tremendous impact long term in your financial plan to make sure you're filling those right buckets up. So, Chris, give us a quick background. Why does this happen every couple of years? And then, let's get right into it.
Yeah, the big reason is just, as with everything, inflation kind of impacts these limits. So over time, the IRS generally just increases the amount that you can contribute each year. Usually it's about $500, but not guaranteed every year. They announce it around this time of year.
Okay, perfect. Yeah, and so if you think about $500 and compare it to 401ks, I think under 50 was $23,000, went up to $23,500 in 2025. So just on a relative basis, it's just over 2%. But if you compare that, inflation was in 2022, it peaked at 9%. There was a pretty big increase, but now that inflation's kind of cooled off, between 2 or 3%, we're seeing quarter over quarter. That does make sense. So make sure you take advantage of it, though. So, what are some of the other key legislative updates that have affected this?
Yeah, so one thing is it's called the Secure Act. So I think in 2018, I believe they came out with the first iteration of that, and over the years they've continued to update the rules. So part of that is going to impact if you're over 50, catch-up contributions. So now, if you're between the ages of 60 and 63, there's a higher catch-up contribution. The normal catch-up applies if you're over 50. It's $7,500 extra that you can do into a 401k. And if you're between age 60 to 63, it's 150% of this, or $11,250.
That's a big change. That's a lot more that you can put in. Well, 50% more, obviously. Yeah. But those that should take advantage of that. Yeah,
and then it's only from that window, though, from 60 to 63. At 64 and older, it goes back to the $7,500.
That's effective this year, or that goes into effect 2026?
That piece is effective this upcoming year in 2025. And then in 2026, there's supposedly that IRS is going to require that catch-up contributions have to go on a Roth basis. So they're not.
That's if your earnings are over $145,000 in the Social Security wages, right?
Yep.
Okay.
Yeah.
Interesting. Yes, they obviously want to take advantage of getting the taxes now. They're thinking short term, I think. So, okay, perfect. Well, let's just rapid fire. So 401ks, Chris, what were they before? What are they now?
Yep. $23,000 in 2024, $23,500 this upcoming year. Catch-up contribution stays the same with the exception of ages 60 to 63. So that's going to stay at $7,500.
And then we always hammer what's called this 415C limit, which affects what's called the mega backdoor Roth. And if you have a 401k that's comprised of you doing an elective deferral, which would be Roth or pre-tax, getting an employer match plus a profit share. Some plans allow the option to do this mega backdoor Roth where you fund after tax and then convert it to a Roth, I should say. So that's gone up as well. So what's the total amount that can go into a 401k now in 2025?
Yeah, so the total, it's up to $70,000 this year. So it's
under 50. Mm-hmm. And then you said the catch up, so $77,500 over 50.
Yeah, that's right.
So most people think, I can just put in the 2025. You can put up to $70,000 if you're under 50. Mm-hmm. $77,500 if you're over 50. Yeah. So look at plan rules. If you have the cash flow, it can make a tremendous impact for tax deferral, tax savings long-term, asset protection by holding, long-term savings inside of 401k, et cetera. So definitely worth looking into, can you get the $70,000 in per year and go above and beyond just what you put in plus employer match. So, okay, 457s, same deal, right, Chris, going up from 23 to 23,500. Catch-up rules are unique per plan, so you need to talk to your plan administrator for the details specific to your plan on the 457s. What about IRAs? Any changes with IRAs?
No changes with as far as traditional and Roth IRAs. Technically, a SEP IRA, that is going up to 70,000 that you could do there, but
So traditional Roth, 7,000 in 2024, under 50, 8,000, over 50. That no changes to that in 2025.
no.
Income limits. What's income limits and contributor Roth or traditional?
Those have been adjusted slightly just for inflation. Looks like the phase out 126 to 146. You're phased out of making the direct contributions. So
Gotcha. Okay, and then I see married finally joined here, 236 to 246, and single. Was that 2024? It looks like single is 150 to 165.
oh yeah, sorry, misread that.
So
Yep.
that's gone up significantly, but obviously we have the workaround for high income earners utilizing the backdoor Roth. You just need to make sure there's no aggregation. You don't have any other IRA balances, including pre-tax SEP IRA. Get all that stuff rolled to a pre-tax 401k, and then you can do the two-step process. No matter how much you make to get the money inside of the Roth IRA via backdoor Roth. Contribute to a traditional on an after-tax basis, convert to Roth, make sure you work with your CPA, your tax preparer, to fill out Form 8606 correctly. We find that form is not filled out correctly, so a lot of people are paying double tax when they do that backdoor Roth, which would make it totally not worth it. But we've amended a lot of returns now that we have our CPA in-house and saving people like $1,500 to $2,000 when we see that
Right.
mistake in 2023. So, okay, SEP IRA. So same thing as the 401k, up to 69,000 in 2024, now 70,000. The big change now in 2024 with the Secure Act with the SEP, this is very interesting as what?
Yeah, so now you can contribute on a Roth basis to a SEP IRA. Typically, in the past, those are all deductible contributions.
Yeah, some people would do a 401k just for the sake of having that Roth exposure as a business owner. You have to do a TPA fee and kind of involve. It's more of a process. SEP IRA is just like open up the account, boom, it goes right in your tax return. So if you want to do a Roth now, you can do a Roth through a SEP. That's a huge change. That's big.
Right.
All right, so the contribution limits for simple IRAs, really simple, up from 16 to 16.5. Chris, what about like health savings accounts, HSAs, FSAs, that kind of stuff? Any changes there?
Yeah, those have been adjusted slightly. A health savings account, that's the one that rolls over year to year. Unlike the FSA, that's use it or lose it by the end of calendar year. So the HSA is up from 4,150 to 4,300, and then the healthcare FSA is up to 3,300 from 3,200. So a slight increase for both of those.
Okay, and I would say the biggest thing that can trip people up is what's referred to as the 401A compensation limit. So this was $345,000 in 2024. It's going up to $350,000 in 2025. The reason that's important is the reality is if you're a surgeon making $500,000 and you have a 3% match at your hospital, the 401k, and you're doing a mega backdoor Roth, they don't match 3% of 500. They only match 3% in 2025, 3% of that first 350. So when calculating, okay, let's say you're putting in 23,500, you're getting a match, not of your whole salary, just on the first 350. That's really important data to know how much you have left to reach that $70,000 total bucket limit when doing the mega backdoor Roth. And sometimes we found in very few plans, sometimes if you max out too quickly, the match will stop. And some plans only base your contribution based upon that 350. Some plans base their contribution off of your whole salary. So it's really important to work with a professional to look at your plan rules specifically in your 401k and making sure that you're maximizing it. Is a Roth or pre-tax better? And also making sure you are, in fact, getting the free match throughout the year, and that you're not messing it up essentially, given the contribution limits of the IRS plus your plan administrator details specific to your 401k or 403b plan. Well, I think that's it. So Chris, any closing remarks other than, I would say it's really important to get right on this in January, get all your stuff updated, get your backdoor Roth done, get your 401k updated. Anything else that you would encourage listeners to do?
No, that's it. We'll definitely be in touch with all of our, if you work with EWA, expect us to be in touch to make the changes, but I think that covers all the limits.
Was that a shameless plug for EWA, Chris?
It was, yeah.
Can't fight it. Thanks for joining, everybody. Thanks for tuning in to our podcast. Hopefully you found this helpful. Really hope this is as beneficial and impactful to as many people across the nation as possible. So hit the follow button. Make sure to rate the podcast, and please share with any friends or family members that would also find this beneficial. Thank you very much.